Welcome back to Primary Source China Investment. This week we're on show N6 and we're talking about foreign direct investment. Over the past few weeks, we've been looking at China's trade with specific partners, and we found the conclusion is that trade finds a way. And this goes both for the exporters and the importers. If a government is attempting to hurt or otherwise coerce another government, trade is not a great weapon. That being said, policy does matter. And those trade barriers, bans, and regulations have derivative effects, and that's on foreign direct investment. And this week, we're looking at the shifting destination of FDI. We have 6 observations to share, and we promise to go fast. So, Pengguo, wherever you want to jump in, just cut me off.
Okay.
Number 1, global FDI is stable on this chart, but more accurately, it's declining as global GDP grows. So global FDI as a percent of global GDP is shrinking. Number 2, the ASEAN countries have overtaken China as a bigger destination of foreign investment. The US is the largest destination for FDI, but in Asia, we're seeing the 5 largest Southeast Asian economies, India, Thailand, Singapore, Vietnam, and Malaysia, accounted for 96.5% of manufacturing FDI pledged to that region. And that region has now eclipsed China in terms of a destination for FDI. Number 3, China is a big piece of that. So China is investing in a lot of these Southeast Asian economies. A third of the region's manufacturing FDI in 2023 came from China itself, up from about 18.5 before the pandemic. In fact, Chinese investment was more than triple that from other major source markets like the US, South Korea, and Japan, according to FDI markets. So why don't we take a break right there and discuss what's going on here. Pengguo, what are your thoughts?
I thought China is already have the big change. 30 years ago, they always attract the foreign investors. But as with the growth of China, it's become a capital export country. So this is a huge difference. And also, it's a kind of the mature of the economies, the natural ways. In 2023, in China have the direct investment over 1 trillion, 1.04 trillion renminbi. So its growth almost 1%. Yeah, and also China domestic investors have the global investment. So the growth is pretty big. It's almost like 16.7%. Yeah, so that means it's very important that China play a role for the direct investment for the global economy.
Yeah, that's a great point. Part of this is dual circulation. Remember that concept that China is going to build out its domestic market and then take that expertise and bring it globally. The other is Belt and Road. So we're going to get to a little bit of that going forward. So let's move on to point number 4. Like you say, Pengguo, investment into China has declined significantly. Even normalizing for COVID, the chart still has a negative slope. And 2024 numbers are looking bad. Foreign direct investment into China shrank by almost 20% in January and February. But as foreigners find alternatives to China, like you say, China's outbound investment is at an 8-year high. Chinese companies made 243 billion renminbi, about 33.5 billion in FDI just in the first 3 months of 2024. So we can look at what is China investing in then, right? Where is their outbound investment going and what's it doing? So we have Africa as a bit of a template. Beijing saw the opportunities in natural resources 20 years ago. And now China is running a robust trade balance. They're getting oil, liquefied natural gas, timber, gold, copper, uranium, precious base metals such as cobalt and lithium. And in turn, China is sending electronic products and other merchandise that Chinese manufacturers on the mainland have produced. You can see this chart here. Of course, history doesn't repeat, but the investment into Southeast Asia and Mexico, where they will build products for local markets and the export market, which may eventually reduce China's trade surplus. China's exporting of capital is hand in hand with its manufacturing base. And you see that Africa was a great example of that. So we're not putting a good and bad. It just is. This is what's been happening. And you have a
Yeah, I
track
think
record of 20 years.
China has a clear policy and strategy. It's not a top secret. It's really like the open policy to the world. So I think it's not easy to get foreign investment, and people, whoever the company, they have to follow this policy, especially for the state-owned companies. I think one belt and one road in those countries, they get more benefits. So the overall, I think the direct investment increased probably 22%. That's much higher than any other countries. For the category, is really, like you said, it's like the TMT manufactured and miner and natural resources.
This is a great lead into point number 6, and we're going to get through it. Outbound investment by China is dominated by the not so invisible hand of the state. Like you say, it's not a secret. Whereas European and US outbound investment is driven by private companies. Think about the Belt and Road, where every company from construction to railroads to financing were all state owned. When you peel back the various JVs and industries, you'll find the same SOEs and SOE adjacent types of companies. For example, the largest nickel producer on the planet and the one operating with the largest investment in Indonesia is Tsingshan Holdings. This is a large SOE. It's a private company, but it's in name only. In defense of Tsingshan, they actually saved the Indonesian business from completely failing. So we're not here to throw shade. We're just pointing out the differences between China outbound foreign investment. Similar to the recent Mexico announcement that Linggong Heavy Machinery, Linggong Jichuan, is leading the build out of an industrial park in Nuevo Leon on the Texas border. Yes, Linggong is a state-owned company. Now contrast that with the US largest investment in Mexico, which was Tesla, Walmart, and AT&T. The effect of this over time is that country of origin is going to change when discussing trade. Let's look at Tesla. It's already exporting 30,000 vehicles a month out of their Shanghai operations. Some viewers might recall a wholesale shift in a place called Prato, Italy, where long-standing family businesses were usurped by entrepreneurial Chinese entities in the clothing trade. It seems like Pinduoduo through Temu has evolved this again and simply figured out what people want, and that's a $6 item of clothing. Made in Italy label has now degraded for all but the poshest of brands. So this is how trade continues to evolve, and FDI creates these derivative knock-on effects. Hongguo, I'll give you the last comment here after we got through all 6 of these.
Right. I think another very important thing is people might be ignored is China have the merge and the acquisition globally. So basically, it's quite a balance. In the North American, it's almost 10 billion. In the Europe, it's 10.4 billion, and in the Asia, it's 11 billion. Obviously, some of the small numbers in other area.
That's cross-border M&A, right?
Merger and acquisition, yeah. Another very important thing is China have the construction project. So that is pretty much in the one belt and one road countries. Those grows much quicker, like 5.7%. So and those 2 areas also means direct investment or comprehensive kind of the investment in those countries.
Absolutely. So we're going to leave it there for show N6. Thanks for tuning in, and we'll see you next week.
Thank you.